All right. Good afternoon, everyone. My name is Jonathan Levin. I'm a columnist with Bloomberg Opinion, here to talk about Fed Day, to process the FOMC decision as it comes in, and to read the tea leaves here in the summary of economic projections and so forth. Here with me today, Allison Schrager. She's a senior fellow at the Manhattan Institute and author of An Economist Walks into a Brothel and Other Unexpected Places to Understand Risk. We've got another special guest coming shortly. I'll introduce her when she gets on screen. But in the meantime, we are expecting today a 25 basis point cut. That would bring us to a new range of 3.5 to 3.75%. You know, it's been a little bit of a hazy period in monetary policy. We have two-sided risks to both the employment mandate and the stable prices mandate. But at the end of the day, we come into this meeting with the market looking quite confident that we're going to get this 25 basis point cut. So, Allison, what do you think we look for here? Where does the element of surprise come from?
Well, I mean, on the one hand, I think there'll be some dissents, probably in both directions. So it will be interesting to see where those are coming from, particularly with the change in leadership next year, to see, what the composition of the board is going to be and sort of people's different outlook. Because, I don't think this is an easy decision. I mean, you could even probably justify raising rates right now, given where inflation and affordability concerns are. So you could cut, you could raise them, you could leave them the same. I think you could make a case for all of that. And I think we'll probably see different members of the board make those arguments. So it'll be interesting to see where they're thinking and how next year is going to play out.
Well, but wait, so that's a pretty powerful statement that you just said, that you could even justify raising rates here. Unpack that a little bit for us, Allison.
Well, need I remind everyone, because it seems the Fed has sort of given up hope, that although I'm sure their projections will say otherwise, that, inflation does seem to kind of be happy and leveling out at 3%. It's 100 basis points above target. And, given where they're probably going to cut rates too, that does leave the Fed funds rate kind of like at 25 basis points in real terms. So, you could say, hey, we need to raise rates. Affordability is becoming a big issue. People are getting very anxious about price increases. You could argue, hey, we need to raise rates to rein in inflation and sort of signal to markets that we are taking inflation seriously. That potentially could even perhaps lower the 10-year, which seems to be rising based on inflation fears.
Yeah. And how do you think the Fed is thinking about the risks going forward? You think they should be thinking about maybe even some sort of reacceleration next year as we get some of those fiscal impulses from the big beautiful bill and so forth?
Yeah, for sure. I mean, as I said, we have sort of some sort of fiscal spending going on. Like, you're seeing people like Torsten Slok become convinced that we're going to have a big of a boom between the fiscal stimulus, between the AI train keep going. So and also, as I said, we could have, as more tariffs take effect and become more integrated in prices, because a lot of sort of a lot of retailers still have not put in tariffs into their prices. We could end up with sort of, as I said, higher prices next year for a lot of reason and increased demand, and that will put the Fed in an even tougher spot.
Yeah. Well, I want to welcome our other guest, of course, our good friend, Claudia Sahm, chief economist at New Century Advisors and a former Federal Reserve economist. Great partner to have on this stream here as we process the decision that's going to come down the pike in just about 40 seconds now. Not much time to get into anything else, but I will remind folks, the expectation going in here from the Bloomberg consensus is that we are going to get a 25 basis point cut. It'll bring us to 3.5% to 3.75%. That'll be your new policy range. And we're going to be looking very, very closely at the tea leaves. We're going to get a new summary of economic projections. It's going to tell us how the members of the committee are thinking about the economy now and where they think policy may be going. So let's give you the numbers as
Yeah, it
projects
looks
5 to 3.75. Go ahead, jump in there.
I,
Okay, so off the back of that, we see stocks moving a little bit higher initially here, and we are going to bring you the headlines on the on the rest as they come. The Fed says that Schmidt and Goolsbee have dissented in favor of no rate change here. So that's interesting. That's part of what Allison was underscoring going into this. The Fed median projection maintains 25 basis points of rate cuts in 2026. So that is no change, but it sort of tells you something about how uncertain the path ahead is here. So Claudia, let me welcome you into the conversation here. What do we make of this initial constellation of headlines and data?
Well, on a first read, I think is probably what we were expecting coming into today, right? So the cut went through. So they've done, 75 basis points of reductions this year that are based on trying to, give some support to the labor market, take out these downside risks to employment. And that is notable given the inflation is still elevated, which then very much segues into, we see dissents today. To have three dissents on the vote, going in different directions, again, is very consistent with the kind of Fed speak coming into this meeting, which showed a lot of differing opinions about what's the right thing to do at this meeting. And yes, it is pretty notable that projection, back in September, the median dot was for 3 cuts this year and 1 cut next year. After a lot of drama and a lot of data and kind of hand wringing, that's exactly what we ended up with this year and the projection for next year. Those are medians. There's a lot under the hood, but that we're still kind of pointing that direction.
Absolutely. Allison, how does that 1 cut for 2026 feel for you? Obviously, this is sort of the center of the distribution for people. There are a lot of different scenarios, a lot of different ways that this could play out, and we could very likely see policymakers revising the way that they're thinking about the economy as data starts to come in. But does 1 cut in 2026 feel reasonable to you?
Well, it's what feels reasonable to me. What I think they're actually going to do. That might be 2 different things. It doesn't seem that, Jay Powell, he's like no Alan Greenspan. He does not like to make surprises. He's like, this is what I'm going to do. I'm going to follow through in it. He does not like to keep the market on its toes. That's not his bag. So I think there's reason to expect, a rate cut next year, short of, a real move, sort of change in inflation, especially because the labor market is weakening. And it does seem like short some, again, some serious tariff movement or big spike in demand, that inflation is sort of like settling in at 3%. And, they seem okay with that. I haven't looked at the dot plot yet. I assume that they still have this projection that within 5 years, inflation will be 2%. Claudia could say more than I have because she's worked at the Fed about whether or not these dot plots are just turning into like actual projections based on data or they're just becoming a vision board. But, I think there's reason to be optimistic if you think that's a good thing that we're going to get a rate cut next year. Because I said, Jay Powell doesn't like to make surprises.
All right. Well, Claudia, shots fired over there by Allison Schrager. So I don't know if you want to defend the Fed here, but go ahead. Take the mic.
Yeah, one thing I'd say about these, the summary of economic projections, this dot plot, it is a strange beast, right? This is not just a forecast. This is really asking each Fed official to think about what's appropriate policy. So one of the reasons that they always end up with 2% inflation at the end, remember, this Fed has agreed that their target is 2% inflation. So if you sit down as a Fed official and at the end of the day, you don't end up with 2% inflation, well, then why didn't you have a higher path of the Fed funds rate? Or why didn't you, you should be making adjustments to what's your appropriate policy to get to what the committee has agreed is the goal in the end. So I know it still is, point well taken. These are always like a few years out. We get to 2%, but like the exercise is like, that's where you should get to. And it's really in very bad times that we don't get to kind of the 2% at the end of the projection or the end. So it's kind of a strange animal, but the reality is we've had a Fed saying, for multiple years now, in 2 years, we're going to be back to 2%, right? And I think this Fed is still very much committed to the 2% inflation target. They're not committed in a way that they're willing to risk a recession to get it. Especially not, I think, at the levels that we're at right now. I mean, they were pretty aggressive back in 2022 raising the Fed funds rate because inflation was at very aggressive levels. I don't think that's, they're putting more weight on the employment side right now, but there's absolutely, and this is part of where the disagreements are coming from among the committee as to whether they should be keeping rates on hold or cutting.
Yeah.
Yeah,
Well,
it just doesn't seem
that's great, Claudia.
That it doesn't seem strikingly. I understand why they put 2%, because otherwise they're saying we have a new target, and they don't want to sneak that into a dot plot without some communication first. I get that, but it's starting to feel just sort of silly. It's like nothing about their path of rate cuts seems consistent with 2% inflation. Like effectively, where we're going could be even negative real interest rates, and yet inflation is going to come down in that environment. I mean, I understand why they do it, but I'm just starting to wonder if the dot plot is just losing all credibility.
Well, let's put some numbers on this conversation, because I have up here the whole SEP. So let's go through this and let's see if this makes sense to all of us as a constellation of data points here. So what we've learned today for folks, I know this is fairly small print. Maybe I can blow it up a little bit. But what we've learned today is that the median projection for 2025, which is basically over right now, is that we're going to see 1.7% growth in real GDP. 2026 is interesting. The median prognosticator, the median contributor to this summary of economic projections has growth at 2.3%. They've bumped that up from 1.8% in September. That's interesting. Could be a number of things. I mean, of course, we're probably going to have a rebound quarter in the first quarter of 2026 coming off of the shutdown. There's that. We could talk about whether or not there are some fiscal impulses coming in here from the big, beautiful bill. Things like that. Beyond that, unemployment, the unemployment rate, which is more directly a target variable for the FOMC than GDP itself, the committee has that. The median member of the committee, I should say, has that coming in at 4.5% this year, no change from the previous projection, and 4.4% next year. So although I think when you dig into the guts of this report, people are acknowledging risks around employment, it does not seem that their base case is all that alarming on unemployment. PCE inflation, the committee sees it coming down, but as Allison, I think, is alluding to, they see this process happening slowly. They have this headline PCE year on year, 2.9% to end 2025, 2.4% to end 2026. So, and recall that by the time we get to the end of 26, we're now talking about something like 6 years above target. 2027, we still haven't made it all the way back to target, but 2.1%. Is there any practical difference between 2.1% and 2%? Probably not. But looking at this and understanding that the committee is asking us to basically be okay with a 6th year of above target inflation, I can see the Allison Schrager perspective. What more can you bring into the conversation based on what we've learned here from these projections, Claudia?
Right. I guess one thing I would say in terms of the inflation, if we look at, if you look at top line over this year, there's really been no progress, right? The cuts that have been made have not been about, last year, there were cuts made by the Fed on the funds rate because we'd seen a lot of disinflation. That is not the case this year.
Whoops, I think we've lost Claudia. You can still hear me all right? Is that right?
I'm good. She just is having technical issues. It's just, this is what bothers me about this. I just see in this dot plot so much like logical inconsistency. Like GDP is
Tell me
going to
where.
go up.
Tell me. Yeah. Okay.
GDP is going to go up. We've got interest rates going down, yet we also have inflation going down. Like, how does that? What do they think is going to happen? Is there going to be some huge like increase in supply? I mean, I said we're going to have more fiscal stimulus. We're going to probably have more effects of tariffs. Like, how does this all add up?
Well, let's bring in Claudia for that. Did you hear Allison's point, Claudia?
Yeah, my computer is on Allison's side. It like boots me out. No, I think one thing I'd say with the inflation, part of the reason we didn't make any progress this year is the tariffs were rolled out. And if you look at the different components of inflation, we went from goods inflation that was actually dragging down overall inflation last year to it being a boosting of inflation. And we do think that those tariffs, their level effects, and once those go through to the price level, then that inflation increase ought to then subside. We haven't seen evidence of that yet. We're not through that full process, but on looking at other pieces like the shelter disinflation has really been moving this year, right? So that's part of what was the offset. Other non-shelter services has been stickier on inflation. It's harder to point to that, but overall there are I think very good data evidence, kind of policy grounded reasons to think that we're going to probably starting in the middle half of next year see some improvement on inflation. Whether that gets you all the way to 2%, and there could be other factors that come up, like you talked about the reacceleration in demand. I mean, that could work in the opposite direction, but there is a story behind why the Fed is looking through some of the inflation that they've got right now.
All right.
So what is that story? Like, what is driving inflation down over the next year? It's just tariffs become like, we just have this like bump from tariffs, and eventually they sort of just get level set. And really, if it wasn't for tariffs, would be at 2.5% now. Is that?
I mean, that really is a lot of the thinking. In terms of, and again, you can see it in the goods price inflation. You see a very clear inflection in the level of goods prices in about the middle of this year, and the tariffs are, they're a 10%, 20%, whatever they are on the imported goods. So you do have, once the level of ratchets up to cover those costs, well then like it's not clear where you would get the second round effects to create more inflation. So I mean that is the kind of story, and I think we will hear that in the press conference again today about that's a dynamic that's one reason to be less concerned about the risks of inflation getting stuck.
Right.
So do you think there's something to the story that a lot of retailers have been running down inventories and haven't really put in tariff prices yet? And that's one of the reasons. I mean, we've seen some sparks of goods prices going up around tariffs. We do see that, but not as much as we thought there would be. So, I mean, some of the tariff increases might sort of still be coming in 2026 because, I've heard stories, I don't know how credible they are, that some retailers were holding off until after Christmas, all these stories.
Yeah, no, I'm totally with you. I think, one of the reasons that we haven't seen the pass through come as quickly into the consumer prices, demand has been on the soft side. You start handing out a bunch of tax refunds and, consumers have the ability to pay. That may be the moment that then businesses push through those tariff costs. But it still has this logic of there is a kind of lump of costs, as long as the White House doesn't ratchet up the tariff rates even more, that once you have done the adjustment, we may still go higher on inflation, but it will work its way out. Price level adjusts, inflation comes down. I mean, that's why I said I don't think we're going to really see that, the goods price inflation coming down until the middle half of next year, because I think you're absolutely right. In the early part of the year, we could see more of that pass through happening.
Yeah. Another one that is really hard to wrap my head around is how we should be thinking about artificial intelligence vis-a-vis monetary policy, because you could make a case, and I think it's very hazy, very, very hazy, whether or not we're seeing any of this at all in the data already. But you could make a case that if there is AI-driven productivity coming down the pike in the next 2 or 3 to 5 years or something like that, that could be disinflationary on the one hand. It may also drive up the demand for investment capital. It may mean higher potential growth and higher steady state interest rates. So how might all of this net out, and how should the Federal Reserve be thinking about it right here, right now, at this important inflection point in monetary policy? What do you think, Claudia?
So I think they're going to have to see something in the data, because this really could go in a lot of different directions. Stephen Myron has talked about, and Kevin Hassett, who could potentially be Fed chair, has talked about that disinflationary aspect of AI, and that one can make that case. But I think for the Fed to actually be acting on it, you're going to have to see some evidence of it, right? And and we're not, and that's going to be a pretty high bar. And I do think, the Fed cut today, every cut that they do, the bar is higher for the next cut, right? And so I think in a good news scenario, if the world evolves the way their forecast is, this is probably the last cut of the Powell Fed. Right, because they're gonna, if things go reasonably well, they're gonna want to wait until they start seeing inflation move down. And again, I think that's probably after he's finished in his chairmanship, and it's like in the later part of next year. But and I think really for AI to be showing up in the data and kind of really transforming the way the Fed thinks about it's just, I don't know that's a 2026 phenomenon.
Fair enough. How do you think about that, Allison? How do you think about the AI
I'd
piece,
be skeptical. I'm generally an AI optimist, but I'd be skeptical it could even be a 2030 phenomenon. I mean, if we see evidence from other big technology, it takes a long time to really show up meaningfully in productivity statistics. I mean, the steam engine took 150 years. I don't think it's going to take that long. But, we still aren't really seeing productivity from the internet. And, that was the 90s. So I think these technologies really do transform work, but it's really, maybe it's the way you could argue the way we measure productivity. But I think to have a solid data case of this is deflationary, it takes a very long time. And it also changes the way we look at and understand data. And that takes even more time. And instead, I'm definitely an AI optimist. But it's also going to put other pressure on them, certainly in terms of labor disruptions. I'm not someone who believes that AI will take all the jobs, but there could be a lot of disruption along the way, a lot of jobs sort of disappearing, particularly if we end up with a recession, which, is likely under the regime of a Hassett Fed just because recessions happen. And if that's the case, I don't see AI like really eliminating jobs right now, but you have a tight bottom line and AI can do the job of someone who's, maybe not completely critical. They lose their jobs. So it could accelerate more job loss than we would normally see during a recession. And I think that would be sort of more of a first order issue for the Fed rather than, inflation relief.
Okay. So another issue I wanted to turn to here, we've alluded to it. As of May, we're going to have new leadership over at the Fed. It's not like we flip a switch and everything changes, because this is a central bank where policy is made by committee, and you have the governors who get a vote. You have a rotating cast of presidents, and it is very hard to imagine a scenario in which somebody new comes in and the entire tone changes overnight. But the role of chairman is important. And President Trump has a short list of folks. I would say that on the whole, they seem to align with his thinking that the U.S. needs to move towards lower rates. The favorite, according to Bloomberg's own reporting and betting markets, is Kevin Hassett at the moment, close confidant of President Trump and longtime economic advisor. But one thing interesting that has happened since everybody started assuming that Kevin Hassett was going to be the guy is that longer term yields have actually drifted up a little bit. Term premia has drifted up a little bit. And so I wonder, Claudia, what do you think that's telling us? And is President Trump going to get what he thinks he wants out of a chair Hassett here?
Yeah, so I mean, an easier said is easier said than done, right? I mean, you alluded to the fact that putting a new chair in, which president is going to, I mean, that it's going to open up next year. That's not enough to move policy. I think one thing that's, to me, the president's been pretty clear about what he wants to see from the Fed. He wants to see lower interest rates, a lot lower interest rates. And listening to comments from him, from Treasury Secretary Besson, I mean, like, they're going to try and pull every lever they can. Putting in a new Fed chair, that's a lever we know they're going to have. It is a powerful one, but it's not, it takes 7 people to lower the Fed funds rate, right? Because it's a vote of 12. Right. But then, there's been a lot of discussion, best talking about, well, maybe some of the Reserve Bank presidents, because they haven't lived in the area, shouldn't be, so it's clear that they're willing to, the administration's looking for a lot of different ways to exercise control over the Fed. And they're going to have to really move interest rates dramatically lower next year, barring a reset, barring really things falling apart. They're going to have some unusual tactics. And it's not clear. And I think, to me, the thing I'm waiting for most is not to hear who's Fed chair. That's going to be who it is. I'm really waiting to hear what the Supreme Court does with Lisa Cook. I mean, if the president is allowed to define what for cause is, remove a governor of the board, we may have Fed chair sweepstakes all the time, because if somebody doesn't deliver what the president wants, you can just fire him, remove him, put somebody else in. So next year could be a really big shakeup at the Fed, or it could just be kind of a messy transition.
Yeah, but if Kevin Hassett gets in there, we're used to seeing him in his political role, in his political persona. Right. And, and you could say ambitious people have to say all kinds of things to get where they want to go. But at a certain point, if Hassett is indeed the guy, he's going to find himself in a room with a lot of smart economists, former bankers, very bright people with strong conviction and a legacy to worry about. And the dynamic between Kevin Hassett and those people, the members of the FOMC, is going to be a lot different. I think they'll probably see a vastly different Kevin Hassett that we see every day on Fox News or whatever. And I wonder, what do you think that dynamic will be like behind the scenes, Claudia? What does he have to do to convince them that he is actually making policy for the right reasons, given some of the natural skepticism that many of us come to the table with?
Yeah, I mean, the economic data drives the decision-making at the Fed. Kevin Hassett has the skills as an economist to make the case, to make an argument. He's got to win over the FOMC. He has the skills, he has the background. He started at the Fed. That's where his career started. He knows how decisions usually are made, how consensus is built. So he needs to do that. The thing is again, I talked about, there may be other levers that may get him to a consensus at the Fed, but then he's got to go up against the markets. If somehow Kevin can push through, or whoever is Fed chair can push through, not based on data, but based on theories, ideas, and politics, blah, 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 the markets are not going to react kindly to that, because they're going to, you think you've seen, yields move up so far. I mean, that would be so I think it's one where for him to be effective, and I think he would want to be effective, he's got to pivot, focus on the data, make the case, do the hard work, and be patient, because it probably is going to take time before some of this actually shows up in the data.
Yeah. Well,
I mean, he is a capable economist. Oh, go ahead. I was just going to say, I mean,
go ahead.
It is his job as head of the NEC, or before in the last administration being head of CEA, to represent the Trump administration and say everything's rosy. He's in a different job as Fed chair. So we might see a different Kevin. Right. I think we might see him. He does want to have a good legacy, and it is his job, if he's appointed to that, to steer the economy in a responsible way. So we might not see a complete toady that a lot of people are expecting.
Right. Fair enough. It's just the thing that I always say is it's going to be a challenge. It's not unheard of for people who have been in executive branch jobs to end up at the Fed. Not uncommon at all. But what is uncommon is for somebody to go directly from this job where they presented a very, very political front and then move into this job at the Fed, which, as we all know, is supposed to be independent by its very nature, at least operationally independent. I'll give you a very quick market update. We've got the yield on the 2-year Treasury note trading at just about 3.57%. That is, of course, down on the day, but it's not much of a change at all from where we were at about 2 p.m. when we got the information. We're going to head over to Chair Powell's press conference in just about 4 minutes. But before we do, I just wanted to close things out here by going around the horn. Allison, what are you still looking to hear from the chair?
Really like his outlook.
Allison,
for
can you hear me?
next.
Yeah.
I'd say his outlook for next year, and certainly how he can sort of justify some of these projections. I mean, I think whether or not we get that rate cut next year, I think he likes to please markets. But it's definitely still in play, and maybe we can get a sense of what he gets. I think if people are expecting a clear-cut data in the next year that would point to a cut or a hold, I don't think we're going to get it. I think we're still going to get a lot of mixed data ahead of us. So I guess we'll get a sense of his mood and whether or not he's got one more cut in him.
Okay, Claudia, is there anything that Chair Powell can tell us that can clarify this data fog that we're living in at the moment?
Yeah, I think, I agree with Allison on what she's looking for. Today people were they're expecting a hawkish cut, right? And we've seen the dissents in the projections. And I think just getting us, last time we got some surprises in terms of the hawkish cut, and just to see what kind of guidance that they're willing to give. And in particular, describing where the committee thinks the Fed funds rate is it still doing any restriction? Is now it neutral? Just getting a sense of how high is the bar for the next cut? What would they be looking for? So it's more about what's the thinking for next year.
All right. Well, with that, I want to leave it there. I want to thank my guests, Allison Schrager and Claudia Sahm. Claudia is chief economist at New Century Advisors. Allison Schrager is senior fellow at the Manhattan Institute. My name is Jonathan Levin. I'm a columnist with Bloomberg Opinion. Your Fed funds rate here in the United States of America, new range is 3.5 to 3.75% after a cut of 25 basis points. Enjoy the Jerome Powell press conference.